Let's say you have $1 million in cash value over the years, you put X amount in, it's now worth $1 million. Something comes up business-wise, an emergency or an investment opportunity, you need $300,000 as quickly as humanly possible, very tax efficiently. You don't want to have to go to your bank and jump through hoops and go through financials. Maybe you're maxed out on your credit. Well, you could very easily call the insurance company and arrange a policy loan for $300,000 on a tax-free basis, as long as what you're borrowing isn't above the ACB. And within a few business days, you'll have that $300,000 and you can use it for your investment or your emergency or whatever. In this video, I'm going to talk about how the majority of my clients use their tax-exempt whole life insurance policies to help with business emergencies, business investments, personal income, and a variety of other perks from these policies. These types of policies can seamlessly integrate into your existing portfolio. So this is your corporation. Most corporations might own some real estate, they might have some cash, some retained earnings, and they might have some sort of a stock portfolio, all of which are great assets. I'm a big advocate of diversification. I think you should have all of these and more. What I'm suggesting is adding an asset, a fourth asset, or whatever number of assets your portfolio, and that would be a tax-exempt whole life insurance policy. Okay, so I'm not suggesting you sell the property to put money here or liquidate the cash. I'm suggesting you add a tax-exempt whole life insurance policy. Now, why would someone do that? Well, I think the obvious point around this type of, it's a life insurance policy, and it comes with, of course, life insurance. It's permanent life insurance, so it's not term life insurance where that could expire or you could outlive it. This is life insurance that is going to stay with you as long as you live. You can also pay it off after a certain amount of years, so you're not stuck with a lifetime of payments, and the beneficiary will get a tax-free payout when you pass away. So those are kind of the obvious points. I think the not so obvious points are the living benefits around the investment part of a tax-exempt whole life insurance policy, and that is called the cash value. So as you put money into these policies, the insurance companies take your premiums and they invest in their own portfolios. Now, these portfolios could be 30, 40, 50 billion dollars in size, and they're investing in things that we typically can't get access to as an individual consumer. In return, the insurance companies pay dividends back into these policies. So you could be receiving annual dividends into your tax-exempt whole life insurance policy and not be paying any tax on the annual growth. So it's a very tax-efficient type of asset to own. The second thing to note is this cash value is guaranteed to increase every single year. So no matter what happens in the stock market or the economy or with interest rates, etc., there's a minimum amount of value that your cash value is guaranteed to go up every single year, and the dividend can be on top of that. It's also guaranteed not to go down. Now, these might seem like similar points, but if something goes up 5% in a year and then down 10% the next year, that's not so helpful. This is guaranteed. It's like a set of stairs where every single year, if you receive a dividend, it's going to increase and it can't go down past that. That's your new bottom line. It's your new step. The insurance company can't take that away or can never, decrease the value of your cash value. Only you can. So it's a safe place to also store your money. And I think maybe one of the third most important point is the fact that this investment account is liquid. And I find there's some confusion around business owners putting money into these policies, but then they're kind of like, well, I don't want my money stuck into these insurance policies, or I don't really know how to get access to it. Is this liquid? Do I have to wait 10 years to dip into it? So the answer is yes, it is liquid, and no, you don't have to wait 10 years to dip into this. You can essentially use it right away. So as you build the cash value up and your portfolio is increasing, let's say you have $1 million in cash value over the years, you put X amount in, it's now worth $1 million. Something comes up business-wise, an emergency or an investment opportunity, you need $300,000 as quickly as humanly possible, very tax efficiently. You don't want to have to go to your bank and jump through hoops and go through financials. Maybe you're maxed out on your credit. Well, you could very easily call the insurance company and arrange a policy loan for $300,000 on a tax-free basis, as long as what you're borrowing isn't above the ACB. And within a few business days, you'll have that $300,000 and you can use it for your investment or your emergency or whatever. If you need more than $300,000, it's still very doable. You could ask for $800,000, $900,000. You could ask for the full $1 million. if that's how much you need, it might make more sense to go to a third-party lender, which could be a bank or a financial institution, and you would use the cash value as collateral, and in return, they would provide you a line of credit equal to the cash value. There may be underwriting with that. Yes, there's interest that's going to be charged on whatever you've borrowed, but it is a way to get access to your cash value for very tax efficient income. Now, the other side of this is going to be if, retirement is approaching, or it could be in, 10, 20, 30 years, there's also an opportunity to leverage this whole life policy for tax efficient personal use. And what you would do is you would use whatever's in the cash value as collateral, you would assign it to a bank or financial institution, and in return, they're going to provide you with a tax-free line of credit equal to whatever's in the cash value. Now, this strategy comes with more risk. There's guarantee fees that need to be paid back to the corp to avoid any shareholder benefit. There's interest rate risk. There's financial underwriting. It always is important to talk with a tax specialist as well before implementing, anything for that matter. But it is an option that you could access, assets in your corporation for personal use, and you could live off the line of credit as part of your retirement income. And if you were, say you borrowed $1 million and you passed away with that balance outstanding, that would come off the death benefit. So if there's $1 million in a line of credit, but your life insurance policy is worth $5 million, well, they would just simply pay out $4 million to your beneficiary. So it's a great way to potentially, add value to your retirement income cash flow on a tax preferred basis, and maybe you're still paying yourself some dividends or some salaries or something like that. But nonetheless, it is a strong asset to hold amongst your portfolio. It's flexible in payments as well. You're not stuck with, X payment, and if you miss by a penny, the policy collapses. We can create policy structures where there's huge swings in how much you can put in, less or more, depending on cash flow and things like that. So it seamlessly integrates kind of with your real estate, your cash, your stocks. The life insurance can also help pay the capital gains taxes on some of the real estate you own. You can also get a CDA credit on passing to help transfer assets out of the corporation tax-free. I have a whole bunch of videos on those sorts of topics, but nonetheless, it's a strong asset to own, and there's a reason that millions of people have this type of insurance. Thanks for watching.